Most people think becoming wealthy is about earning a massive salary, landing some lucky investment, or having a rich family member leave you something. But the truth is far simpler, and honestly, a little unsettling once you see it clearly. There are people out there right now, earning average incomes, living average lives, who are quietly building life-changing wealth. Not because they're smarter than you, not because they took wild risks, but because they understood one concept that most people never truly grasp, and they let time do the heavy lifting. That concept is compound interest. And before you close this video thinking you already know what it is, you probably know the definition. But knowing the definition and actually seeing what it does to money over time are two completely different things. One is a fact you read. The other is something that changes how you live. Welcome to Quiet Wealth, where people who are serious about changing their financial story come to think differently, build slowly, and win for life. Let's get into it. What compound interest actually is, and why schools fail to explain it. Most people first heard about compound interest in a classroom, sandwiched between formulas they never used again. So it never really landed. The teacher wrote something on the board, you copied it down, and then life went on. But here's what they should have said. Compound interest is what happens when your money starts making its own money, and then that money starts making money too. It's not just growth. It's growth on top of growth. Let's make it concrete. Say you put $1,000 in an account earning 10% interest per year. After year one, you have $1,100. Simple enough. But here's where it changes everything. In year two, you're not earning 10% on your original $1,000. You're earning 10% on $1,100. So now you end year two with $1,210. That extra $10 might look like nothing. But that principle, earning returns on your returns, is the engine behind every large fortune built over time. The reason this matters more than people think is that the growth isn't linear. It doesn't go up in a straight line. It curves, slowly at first, almost invisibly, and then at some point it starts to accelerate in a way that looks almost unfair. That curve is called exponential growth, and it's the reason people who start early with very little can end up with more than people who start late with a lot. Time isn't just a factor here. Time is the actual product you're buying. Here's another way to picture it. Imagine a snowball rolling down a long hill. At the top, it's tiny. It picks up a little snow, gets slightly bigger, picks up a little more. For a while, it barely looks like it's growing. But halfway down the hill, something shifts. The ball is now bigger, so it picks up more snow with each rotation. By the time it reaches the bottom, it's enormous. Not because anything changed about the hill, but because the ball itself became the driver of its own growth. That's compound interest. And the longer the hill, the bigger the snowball at the bottom. The rule of 72. The simplest math that will blow your mind. There's a shortcut that financial professionals use constantly, and almost nobody outside of finance knows about it. It's called the rule of 72. Here's how it works. Take the number 72, divide it by your annual interest rate, and the answer tells you roughly how many years it will take for your money to double. That's it. No complicated formula. Just one division problem that hands you a picture of your financial future. So if you're earning 6% per year on your investment, 72 divided by 6 is 12. Your money doubles every 12 years. If you're earning 9%, it doubles every 8 years. If somehow you're earning 12%, your money doubles every 6 years. These numbers might sound dry until you apply them to a real dollar amount. Take $10,000 at 9%. In 8 years, it becomes $20,000. In 16 years, $40,000. In 24 years, $80,000. In 32 years, $160,000. You put in $10,000 one time and did nothing else. What makes this rule even more powerful is using it to see what you're losing when you let money sit in the wrong places. The average high-yield savings account in the U.S. right now pays somewhere between 4% and 5%. At 4%, your money doubles every 18 years. But a well-diversified stock market index fund has historically averaged around 7% to 10% annually over long periods. At 8%, your money doubles every 9 years. That difference in rate, just a few percentage points, means the gap between your final number could be hundreds of thousands of dollars on the exact same starting amount. And here's the thing most people miss. You can also run this rule in reverse to understand what debt is doing to you. Credit card interest rates often sit between 20% and 25%. Run the rule of 72 on that. At 24%, the amount you owe doubles in just 3 years. The car you couldn't quite afford, the vacation you put on credit, the balance you've been meaning to pay off, all of it is compounding against you with the same force that compound interest works for investors. The machine doesn't care which side you're on. It just runs. The time advantage, why starting early is worth more than earning more. Here's a story that sounds almost too dramatic to be true, but the math backs it up completely. Imagine two people, call them Maya and Daniel. Maya starts investing $200 a month at age 22 and does it for 10 years. At age 32, she stops adding money entirely and just lets what she has sit and grow until she's 65. Daniel waits until he's 32 to start, then invests $200 a month consistently every single month until he's 65. That's 33 years of contributions compared to Maya's 10. By every instinct you have, Daniel should come out ahead. He contributed more money. He stayed consistent longer. But at 65, Maya has more. Not a little more, dramatically more. Because she gave her money a 10-year head start. This is what financial people call the time value of money. And it's the concept that separates people who build real wealth from people who spend their lives catching up. A dollar invested at 25 is worth significantly more than a dollar invested at 45, even if the 45-year-old eventually invests far more total dollars. The reason is simple. The 25-year-old's dollar has decades to compound before retirement. The 45-year-old's dollar barely has time to get started before it needs to be used. Most people respond to this by saying, "Okay, but I don't have money to invest right now." And that's fair. Life is expensive. Bills are real. But consider what you do spend small amounts on regularly, and what those amounts would become if redirected. $5 a day. The price of a coffee is $150 a month. $150 a month invested at 8% over 30 years becomes roughly $220,000. The number feels impossible, but the math is right there. The money was never the problem. The awareness was. The other thing time does that people underestimate is it reduces risk. Short-term investing is genuinely unpredictable. Markets move in ways nobody can consistently forecast. But over 20 or 30-year periods, the historical record of broadly diversified stock market investments is remarkably consistent. The people who lost everything in the stock market are almost always the people who needed their money back in 3 years. The people who built wealth are the ones who put money in and didn't touch it for 20. Time doesn't just grow money. It also smooths out the chaos. The vehicles where compound interest actually lives. Understanding compound interest is step 1. Knowing where to put your money to actually access it is step 2. And this is where most people stall. The concept sounds great in theory, but the real world asks a more specific question. What exactly do you invest in? The honest answer is that there are several legitimate vehicles, each with different characteristics, and the right one depends on your situation. But let's walk through the most accessible ones. The first and most powerful vehicle for most ordinary people is a tax-advantaged retirement account. In the U.S., that's a 401k or an IRA. The tax advantage is a huge deal because it means more of your money is working for you instead of going to the government. A Roth IRA, for example, lets your money grow tax-free, meaning when you withdraw in retirement, you own nothing on the gains. If you compound $200 a month for 30 years inside a Roth IRA versus a standard taxable account, the difference in what you actually keep at the end can be tens of thousands of dollars, just from the tax treatment alone. Inside these accounts, most financial advisors recommend low-cost index funds as the core investment. An index fund is essentially a basket of stocks, often hundreds or thousands of companies, that tracks a market index like the S&P 500. Instead of betting on one company doing well, you're betting on the broad economy doing well over time. Historically, the S&P 500 has returned around 10% annually on average over long periods, though it swings dramatically in any given year. The key word there is average. Some years it's up 25%, some years it's down 30%, but zoomed out over decades, the trend line goes up. The thing that kills compound interest in these accounts is fees. This is something that gets glossed over in most conversations, but it's critical. Fund managers charge fees called expense ratios, and they're expressed as a percentage of your investment each year. The difference between a fund charging 1% and a fund charging 0.05% sounds tiny. But on a $500,000 portfolio over 20 years, that 1% fee could cost you over $100,000 in lost compound growth. The fee doesn't come out of your pocket directly, it comes out of your returns. And when those returns would have compounded for decades, every fraction of a percentage point matters enormously. The enemies of compound interest. What quietly kills your wealth? Compound interest is powerful, but it is not invincible. There are forces working against it every single day, and most people invite those forces into their lives without realizing it. The most direct enemy is inflation. Inflation is the slow erosion of your money's purchasing power over time. If your money is sitting in an account earning 2% and inflation is running at 4%, you're not actually growing your wealth at all. You're losing ground. The number in your account goes up, but what that number can buy goes down. This is why parking cash under a mattress, or even in a very low-yield account, is not a neutral choice. It's a slow drain. The second enemy is consumer debt, and it deserves to be said plainly. Debt is compound interest working against you. When you carry a balance on a credit card at 22% interest, that balance is growing every single month, whether you touch it or not. It's the same mechanism as a retirement account, just running in the opposite direction. People who spend years trying to build wealth while also carrying high-interest debt are essentially trying to fill a bathtub with the drain open. The math doesn't work. Clearing high-interest debt is often the single highest return investment a person can make, because stopping a 22% loss is equivalent to earning a 22% guaranteed return. Lifestyle inflation is the third enemy, and it's subtle because it feels like success. When people earn more money, they tend to spend more money in proportion. The raise comes in, and within a few months the new salary feels normal, the expenses rise to match it, and nothing has actually changed in terms of what gets saved and invested. The people who build wealth through compound interest are almost always the ones who aggressively resist this. When income goes up, the investment contribution goes up first before the lifestyle adjusts. That's not about suffering. It's about understanding that an extra $300 a month invested in your 30s is worth dramatically more than an extra $300 a month spent on a nicer apartment. Waiting is the fourth enemy, and it might be the most dangerous because it doesn't look like a problem. It looks like caution. I'll start investing when things settle down. I'll start when I have a bigger amount to put in. I'll start after I pay off this one thing. Every month of waiting is a month of compounding you can never get back. The best time to start was 10 years ago. The second best time is today, with whatever amount you can manage, even if it feels embarrassingly small. A small amount earning compound returns for 30 years will embarrass a large amount that's sat in cash. Building the habit. What ordinary people who get rich actually do. Wealthy people from ordinary backgrounds don't usually have a dramatic story of one big bet that paid off. When you look at the actual patterns, what you find instead is almost boring. Consistent contributions over long periods of time, in accounts with decent returns, with lifestyle costs kept lower than income. That's it. The consistency is the secret ingredient, and it works because of something called dollar cost averaging. When you invest the same amount every month regardless of what the market is doing, you automatically buy more shares when prices are low and fewer when prices are high. Over time, This smooths your average cost down and removes the need to time the market, which even the best professionals consistently fail to do. Automation is the practical tool that makes consistency possible. The people who decide to invest whatever is left over at the end of the month almost never invest anything, because life has a way of spending whatever is available. The people who set up an automatic transfer on payday before they see the money, before they have a chance to decide they need it, almost always end up investing. It removes the decision from the equation. When the behavior is automatic, discipline is no longer required. The system does the work. One of the most overlooked aspects of building wealth through compound interest is the psychological component. Markets drop, sometimes dramatically. 2008 saw the S&P 500 lose about 50% of its value. COVID in 2020 brought a 34% drop in about 5 weeks. In those moments, everything in your gut tells you to sell, to get out, to stop the bleeding. The people who did that locked in their losses and missed the recovery. The people who held, and better yet, kept contributing, came out the other side in a significantly stronger position than where they started. The market rewarded patience with remarkable consistency. Emotional decision-making is how ordinary people turn a temporary loss into a permanent one. Here is the thing about compound interest that nobody really tells you. It's not exciting. Not at the beginning. For the first several years, your account balance grows slowly, and it can feel pointless. You're putting money away every month, and the number barely moves. Most people quit during this phase because they can't see the payoff yet. But this is the phase where the foundation is being set. Every dollar invested in these early years has the longest runway ahead of it, the most time to compound. The people who push through the boring early years are the ones who look at their account balance in their 50s and feel something that's hard to describe. Not just relief, not just security, a quiet, deep satisfaction that comes from having made a decision years ago and having the patience to let it play out.